So thank you, everyone, for joining us today. What is Life After Coronavirus, PPP, the final chapter, presented by Ray & Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We'll be working to respond to as many questions during today's presentation as possible. If you registered for today's webcast, you will also receive the recording of today's presentation, as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and our presenters. Your feedback is important to us as we determine future webinar topics. Also, if you'd like a copy of today's slides, you'll find that they're available in the handout section of the webinar dashboard on your computer screen. Today's webcast will be given by Doug Hauser and Paul McEwan. Paul McEwan is the principal at Ray & Associates, where he leads the firm's retirement plan consulting and administration services team. He's responsible for consulting with clients on fiduciary best practices related to their qualified retirement plans. With more than 30 years of accounting industry experience, his areas of expertise include retirement plan fiduciary issues, plan compliance, and reporting issues. As the principal and director of constructions and real estate services at Ray & Associates, Doug Hauser is committed to building out and growing the construction and real estate services segment while continuing to ensure that we are known industry-wide. Doug has more than 25 years in the accounting industry, and his areas of expertise include financing structures, cash flow management, balance sheet management, succession/exit planning, and long-term capital event guidance. Today, Doug and Paul will discuss the PPP Forgiveness Application, PPP Loan Flexibility Act, risk mitigation, and address your frequently asked questions amid the COVID-19. And sorry for the early start there, but take it away, Doug.
No, that's all right. Thanks, Imani, and certainly want to encourage everybody to ask questions and get those into the chat as we go. And Imani, please interrupt Paul and I at any time. Maybe we'll try to remember to take a pause here and there to maybe address some questions as we go as well. But we want to make this as interactive as possible, and we will leave plenty of time at the end for questions. So the first thought when I see this, gosh, the final chapter, this sounds like a bad horror movie sequel. And I guess in many ways it is, right, Paul?
I'm not sure what kind of story it is, and notice there is a question mark there, so this may not be the final chapter, but we think we're getting closer to the end than the beginning. So
I guess I'll start off with a question for you, Paul. So this latest interim final ruling that came out, I think a date on it of the 22nd actually, but that recently came out here. What was your biggest takeaway from the clarifications that we got there? I know we're going to obviously get into the meat of this thing, but if there was one thing that stood out to you, what was it?
I'm not sure if I don't have all the provisions outlined by date, like it sounds like you might, Doug, but I think right around in that area there was some we got some information in terms of owner compensation and how it relates to the 24-week period. I don't know if that's what you were driving at or not, Doug, but we didn't know it once, and that was all part of the PPPFA, the Flexibility Act. And again, we'll go through this. We have some slides, but once we got the extension of the 16 weeks so that we could have a 24-week period, what was that going to do in terms of additional payroll costs that would be forgivable? And so the biggest takeaway there was a bifurcation, if you will, between rank and file and owners in terms of compensation for the 24-week period. It remained the same for the 8-week period, but they decided that 2.5 months out of 12 in terms of compensation for owners was adequate. They didn't need to make it 3 times the 8-week amount, which is what they did for rank and file employees. So
yeah, no, I agree with you there. I think, and it's really not surprising as I we think about in retrospect, because the spirit of the program was to keep employees on payroll. So that makes a lot of sense. I was happy to see, and we'll get into this, I was happy to see the clarification about when you can apply for forgiveness too. I think some of that was helpful. So
we'll talk about that. I've had a lot of questions recently from clients and others that we've been interacting with since this whole thing started about, hey, my 8-week period just ended. Am I too late to apply? And so I think there's a lot of anxiety out there. And so if nothing else, want to make sure that everybody understands, hey, you've got 10 months really from the end of the 24-week period to apply. So that pushes you all the way to 2021. And we were talking before we jumped on today, Doug, that we still think you're better off applying sooner rather than later, but don't be concerned that you're going to miss a critical deadline somewhere in terms of your application. Right. I have gotten several people that they weren't necessarily in a panic, but they were very anxious about the end of the 8-week period and wanting to get on with it. And we also got the banks. Some of the banks are ready to accept applications, and other banks are not ready to accept applications. So it really depends on who your lender is as well. So.
Yeah, for sure. I know I have a number of clients, obviously in the construction segment, that just they want to move past it, get it forgiven, and get it off their balance sheet. So I understand that as well. So with that, next slide, please. We'll get into the meat of some of the details here. Paul, you can go through this. Picking up where we left off.
I was just going to jump in and let everybody know I was the one that kind of put these slides together, so I can certainly walk everybody through and kind of let you know what we're thinking or what I was thinking. Put these together. So first of all, it's been a while. May 26th was our last webcast. So just wanted to kind of give everybody a high level perspective in terms of where, a timeline, if you will, of where we are in the process since our last webcast. So since our last webcast on June 5th, there was the PPP Flexibility Act. That was huge. I put down the major bullet points that came out of the PPP Flexibility Act. So we got that relaxation of the 75-25 split between payroll and non-payroll, relaxed to 60-40. We got the concept of a 24-week period, and it's an option, right? So if you get your loan early on, you can stick with.
Excuse me a second, Paul. I think somebody needs to mute there. I think we're getting some feedback from. We don't have somebody mute. It's not you or I, but.
I hear that. I'm going to try to sound there. Give me 1 second.
Hopefully it's not me. All right.
No, it wasn't you or I, because somebody was coughing. So.
All right. So the 24-week measurement period, and the neat thing there. Am I muted or unmuted now?
Now we're unmuted. Okay.
All right.
You're good to go.
Yes,
right.
Much better now. Thank you.
So we still have the 24-week option, but you can stick with the 8-week option if you've spent all your money and you don't have any trouble with any of the forgiveness reduction factors. The 2-year maturity was anybody that applied after June 5th now has an automatic 5-year maturity, and certainly anybody that received a loan before June 5th, which is many of the people we've been talking with, the vast majority, can negotiate with the bank to go from the 2-year maturity to the 5-year. Do you have any comments on that, Doug? Have you talked with your banking associates or friends?
I think most want to see their clients get the entire amount forgiven, because they don't want to, again, the idea is here to not touch as much paper as possible. So, to the extent they don't have to go back and amend and do those kind of things, I think everybody wants to see that happen. But yes, that is out there, and if need be, that can happen, certainly.
And then the 4th bullet point on there, what we, kind of confirmation of what we were expecting. June 30th was really too soon a date for many industries to get back to full employment. And so particularly the restaurant industry lobbied heavily for an extension of that. So pushed back the June 30th date to December 31. And I just put in red there. So now the language is, it used to be no later than June 30th. It's now no later than the application date or December 31, to restore headcount and wages. And the reason I put the application date is because obviously most businesses out there aren't going to wait until December 31. But that was a question mark too. We can talk about that a little bit. But and we just got that guidance this week that no, it's okay. Once you've spent all your money, because that was the initial response we got from many of our clients was, hey, I can't quite get it all spent in the 8 weeks, but if you give me another 2 weeks or 4 weeks, I'm good. And then I'd like to apply. And so we were kind of telling people, well, not sure if you have to wait until the end of that 24-week period or December 31, whichever comes first. Hopefully you don't. We don't think you will, but it was nice to get that confirmation this week that you can go ahead and apply as soon as you've spent your money.
Yeah, I think that's a great point, because we've got a number of folks in that boat. And, you know, again, if they were forced to wait the entire 24 weeks, for example, seeing this in some industries, not for profit, for example, or certain manufacturing sectors that have hit hard, you know, the PPP funds have truly allowed them to keep folks on payroll. But once those funds run out, you know, there's potential for reduction in force and those types of things. And there were a lot of people afraid that, gosh, if I have to wait the entire 24 weeks or December 31st, it's going to throw off my FTE calculation and I'm going to be penalized. Right. So it's nice to hear that that's not the case and you can apply as soon as your funds are spent.
Yeah, I guess I would like to make a comment since you brought that up here in terms of the impact of the 24 weeks. And I've read a couple articles that kind of walk through some different case studies, if you will, some different scenarios. And one of the big impacts that I came away with was just having more payroll to be able to push towards to use towards forgiveness is going to mean that we're starting with a higher bar when we apply forgiveness. So even if you have to use some reduction factor, whether it's related to the wage rates, which we'll talk about here in a few minutes, which we don't think most companies will. Most clients, most businesses that I talk to are more worried about the FTE reduction. But even if you have some FTE reduction, because you're starting with a higher bar, it's very possible that you're starting with this higher payroll number, and even after reduction, it's more than your loan amount, right?
Right.
And so you're going to end up with 100% forgiveness, even if you get a forgiveness reduction factor. And I hadn't really thought that part through until I read that article. So I think that's something else that I just wanted to throw out there. Again, high level perspective, that it was really, really helpful to get this, particularly the 24-week period. And then the 60/40 helps a little bit as well, but it was really the extension. You know, most all borrowers I've talked to at this point think they can use up all their loan proceeds with payroll now. They don't have to worry about the other non-payroll stuff. But anyway,
agreed.
Just wanted to throw that out there. And then the last bullet point under the PPP Flexibility Act, there's a new safe harbor for business activity reduced. If you had business activity reduced during the covered period because of health mandates, it basically means, and again, this was really important to the restaurant industry, who is really, you know, they are really struggling to bring everybody back. As long as you can point to some sort of, you know, state health mandate from the state commissioner or whatever, and that advice was based on guidance from the CDC or some other federal agency, then you don't have to worry about FTE reductions at all. And that gets us around to the new EZ form, which we'll get to here in a second. But yeah, so I call that the kind of get out of the golden ticket or the get out of jail free card. So
right.
That was the other thing that was really, really, really helpful. So,
yeah. Yep. For sure. And then obviously the new IFR, right? Yeah, with it that was out not too long
Yep.
ago. Here.
So right after the PPP Flexibility Act came out, everybody was like, hey, that's really great to go from 75-25 to 60-40. But because of the way the act was technically written, there was some concern that I'm going to have to spend at least 60% of my loan proceeds on payroll, and I'll have to spend, and that'll be calculated based on the entire amount of my loan. I think that concern was probably a little bit overdone, but we did get guidance in that June 11th IFR that the 60%, like the 75%, is proportional. In other words, 60% of your total forgiveness, not 60% of the total loan amount, needs to be payroll related. Now, if you spent all the loan amount, then yeah, ultimately 60% of your payroll is going to be, or 60% of your loan amount is going to be payroll. But that provided some comfort to many people out there. And then what's the other thing I wrote down there? Extension of payment deferral. Oh, that was the other thing. If you took a 24-week period, was your 6-month deferral on your payments going to run out before you could actually apply for forgiveness? So they extended the payment deferral to basically the end of the 10-month application deadline, application period. So
yeah, and the one thing
go ahead. I'm sorry.
I'm sorry. The one thing I'd throw onto that, Paul, too, is that because of that, now for the time being, the entire loan amount is long-term on the balance sheet. And again, that's the guidance we've been providing. Treat this as a traditional loan from a GAAP perspective until obviously you get clarification around that amount being forgiven. But it would all be long-term debt at this point.
Yep.
So next slide, please.
So then on June 16th, we had the drop of the new, what we didn't even know we were going to get a new EZ form. So that was a surprise. But we got the new updated long form is what I've been calling it, the regular forgiveness application, which is still a 3-page form. But they also put out there, and this was in response, and Doug, I'll let you speak to this because you're the former banker, but this was really in response to a lot of concern by the banking community that if we get 4.5 million applications for forgiveness with all of this complexity and all of this documentation, how in the world are we going to process all of this? And by the way, we're not getting paid to process any of this stuff, right? We only got paid to process the upfront loan. So it was really a mismatch between the workload and the resources available. So they did come up with this new EZ form, which I think makes a lot of sense. And from a high level, the EZ form, we have another slide on the EZ form, so we'll get into a little bit more detail. But from a high level, they tried to figure out, okay, who out there in terms of a borrower doesn't really need to prove to us or to document to us how they calculated their FTEs. And if they didn't, for example, if they don't have any employees, why would they need to do the entire form? And prior to getting the EZ form, we were getting a lot of questions from sole proprietors, no employees, with like, where do I start on this? I don't have any employees. It doesn't look like a lot of this applies to me. And yeah, you're right. A lot of it doesn't apply to you. So that was what the EZ form helped with. And then there are some other situations, like if you were shut down because of guidance from the state or some sort of state mandate, like restaurants, hotels, other businesses, barbershops, massage parlors, et cetera, et cetera, et cetera. Anybody that was really had a tough time with social distancing was shut down for a period of time, and now they are not going to have to document they are eligible for the EZ form. So we'll get into how does that eligibility work. But I think as a business, you really need to hone in on which application is best for me, because I can tell you, if you can squeeze yourself into the EZ form, it's going to be way easier for you to get it completed and turned into the bank. Now, some of the documentation is, there's still quite a bit of documentation. You still need to document your payroll costs and other costs that you're applying for forgiveness. But that getting away from that FTE calculation is just, to me, it's huge. So
yeah, a lot of the construction clients that I've been talking to, and many that I continue to deal with, they didn't reduce FTE, still have been running hard. So they fit very nicely into the EZ form. It's very easy to say, yep, FTE is the same or more. And, the payroll costs are have eaten up easily all of the PPP funds. So very simple to go ahead and do that.
And then I think we talked about the IFR 19. I can't believe we've had 19 interim final rules on this thing, but or more. But that came out on the 17th. We've already talked about that's the owner compensation. I can't remember if you got the date right or not on that, Doug, but that we kind of talked about that and how the owner compensation is calculated. The biggest, we were talking before we jumped on live here this morning, my biggest concern, and I listened to the AICPA town hall yesterday afternoon on this topic, and I've got a slide specifically on pension contribution, but I still think there's a lot of confusion, and we're getting a lot of questions about how much of my pension contributions, because it's right, payroll costs are your direct wage payments as well as health insurance for your employees and pension contributions. And so what are my retirement plan contributions, and specifically how does my own contribution for me as an owner, is that included or is it not included? Pretty clear for self-employed partners, independent contractors. You cannot include health insurance or retirement plan contributions for you. Those things are not taken as deductions on Schedule C. Those are deductions taken on the 1040. So that all makes sense to me. Where we were getting confused, and I still think there's confusion out there, is with S and C Corp owners. And they kind of define these as owner-employees.
Right.
And particularly for S and C Corp owners, their pension contributions are taken, on the 1120S or on the 1120. Right. And so it seemed to make sense that it would all be included, except that, things never make sense with the government. So,
right.
And I could see, there being an opportunity for a big loophole for large deductions or large forgiveness for certain owners. So it's essentially, I think where we came out, and again, we have a slide on this, but where we came out is for S and C Corp shareholders, shareholder employees, they're going to be limited. The 2.5 month cap for compensation includes your pension contribution. So it doesn't limit what you're putting into the plan for all of your employees and the non-owners, but your own contribution is limited. Now, and I will show you specifically on the EZ instructions where it doesn't say that, it says something different. And I think that's where the confusion is. So I think we'll get some additional guidance, but at this point I would be conservative in terms of, we are being conservative in terms of what we're telling clients. And I'm hoping it doesn't matter, that for the vast majority of companies out there, they're going to get all of their loan forgiveness in the form of payroll, direct payroll. And so some of these pension contribution issues for the owners in particular are not quite as important as they used to be. So.
Right, I would agree with that. And it was interesting, as you alluded to, that there was a difference in the language on the EZ form versus the quote unquote main form. That made no sense, that there was a lack of consistency there at all. But that's the way it came out. So
well, and again, it's all come out so fast from the government, right? Trying to respond so quickly. I get it. I mean, mistakes happen and things are not necessarily consistent, but it has been frustrating for everybody. You want me to continue through here?
Yeah, I'll just hit this real quick. Yeah, because as we mentioned, you may apply for forgiveness as soon as your loan proceeds are spent. You do not have to wait to the end of your 24-week period. So if you use those up, as we indicated earlier, go ahead and try to get that done as soon as you can. As Paul mentioned earlier, you do have 10 months from the expiration of your covered measurement period to apply for forgiveness. The bank then has 60 days to decision that and forward that to the SBA. So that was all clarified. Again, we have here at the bottom, the deadline is June 30th, although I know some banks have already stopped taking applications. They said, look, if your application wasn't in by the 20th, we're not gonna get you in the queue, and that's that. So if you haven't already done so, you're up against it now for sure. So
yeah, I guess the reason I put that on there is they continue to talk about it on the AICPA town halls that are done every Thursday. And then there are lenders out there that are still accepting applications. So I think a lot of the big banks have kind of shut down their lending operations as far as the PPP loan goes, but there are a lot of fintech companies out there. So if you're having trouble identifying a place to go, certainly you can shoot Doug or me an email, and we'll do what we can to get you some names of some companies that might be helpful. The other thing that I would say is my experience, and Doug, I don't know about your experience, but my experience is community banks have really stepped up, and every community bank that I've talked to so far has said they're still accepting applications. Now that's anecdotal evidence, but I guess I would tell anybody out in the audience today, if you haven't applied for a loan yet, or if you applied for a loan and returned it, and now you're thinking about applying again, don't give up, right? There's still sources out there. You just have to be persistent.
yeah, and the part here too, there's somewhere in the neighborhood of 125 billion that's unused thus far through the PPP program. So the strong suspicion is we're going to have, whether you want to call it a PPP 2.0 or maybe more specifically targeted towards industries that were harmed greatly, restaurants, service, things like that. So sneaking suspicion is there will be something, as Paul said earlier, some type of additional PPP-like stimulus program that will occur. We'll see. So
what I would say, what we're hearing about the PPO2 is I think it is very likely we'll get it, but there will be many more strings attached and eligibility criteria associated with 2.0. So if you're noticing now that you're being impacted more than you thought you would have been early on in this whole process, and you're thinking about applying, I think you're better off applying under this program than you will be. You may not qualify under 2.0. I mean, that's entirely possible. We don't know what the eligibility requirements will be, but I think that it'll be more tied to need, right? You'll have to show some sort of decrease in your revenue or something like that, some sort of impact from the crisis. Whereas here, it was a very general kind of, if you can see that you've been impacted, I can't remember what the certification language was exactly, but it was basically, if you think you've been impacted or you expect to be impacted by the crisis, you're eligible. And certainly, I kind of always simplified it with clients to say, if you think you're going to start laying people off, you should be applying for the money, right? So
yeah,
there's no expectation that you spend your own money first and then go calling on the SBA to spend their money. This program is to keep businesses afloat and to keep people on the payroll. So
yeah. Next slide, please. We'll try to get through these and get some questions going.
Yep. So the new EZ form. So this is the slide I referred to earlier. Much simpler, one page, no Schedule A, no worksheet. I encourage everybody, if you haven't looked at the two different forms, take a look at the forms. If you need a link to the forms, if you haven't seen it yet, you're welcome to send an email to Doug or me. We'll get you those. We've got links directly to the Treasury website where the instructions and the forms are located. But I did, as I referenced before, the documentation requirements are still pretty, I don't want to say onerous, but you've got to document what you put down on the form. So as it relates to payroll, health insurance, retirement plan expenses, if you're including any of those, and then any of the non-payroll expenses you've got to document, and you've got to show that those agreements were in place prior to February 15th. The one benefit you get with the EZ form is there's no longer an FTE, documentation requirement because there's no exclusion on the EZ form. So that's bullet point 2 there, no forgiveness reduction factors, put an exclamation point on that. That's the big bonus you get on the easy form. So then the next question is, well, who's eligible? Can I as a business apply using the easy form? Because that sounds like it's a pretty good deal. I already mentioned, and we won't waste any time on this, but self-employed owners with no employees, that's a no-brainer. They can certainly use the form. Any business. Now here we're going to talk about, because I'm getting a lot of questions, and I know you are too, Doug. Any business that did not reduce any wage rate during the measurement period, that's a common requirement for the next two eligibility criteria. And so what they're getting at there, and I've devoted a slide later on in the presentation, but what they're getting at there is, did you reduce anybody's salary or wage rate and expect them to basically continue to work the same number of hours? In other words, Congress is really trying to control or incent maintaining hours, but they don't want you to maintain hours, pay people less per hour as another way of reducing compensation or saving payroll. So they really attacked the reduction factors from a wage rate perspective and from an hours perspective. And I would say the vast majority of people that I talk to, when I ask them, did you reduce anybody's wage rate? They're like, no, we worked fewer hours, or we didn't have anything to do. So, the hours were less. But if they were making $15 an hour, we kept paying them $15 an hour. They just didn't work as many hours. So that seems to be a real point of I think for many of our clients. So if you did not reduce anybody's wage rate or salary during the measurement period, and this is an either or, and you did not reduce FTEs during the measurement period. So if you were completely unaffected, I think you were talking about some of your construction clients, Doug. They just kept plowing along. They had a backlog of work. Everybody's showing up. Of course, they didn't know how long the backlog was going to be there. So they were conservative, followed our advice, applied for the loan. But they never reduced anybody's FTEs. And I think what the government is saying here is, hey, if you didn't reduce anybody's hours and you didn't reduce anybody's wage rate, then let's give you the short form, because it's kind of stupid to make you jump through all these hoops and prove to us that you didn't do that. Now, you are going to have to document that. So if the SBA or your lender comes knocking and they want to audit your records, then you're going to have to be able to support what you put on and you have to certify. There's a number of certifications on the short form you have to certify. So that's one. So if you never had any reductions in hours throughout the entire covered period, you're good. You can use the short form. Or, and here's the golden ticket we talked about before, if you were shut down during your covered period, either completely or partially, because of guidance or mandates from the state health commissioner or whoever, in order to, improve social distancing or whatever, or just to be in strict compliance with the mandates, then you don't have to, then you're not going to, you can use the easy form and the reduction factors aren't going to apply to you either. So that was huge. That was huge. And I think I don't know what percentage of borrowers are going to be able to use the easy form, but you and I, Doug, have talked about, I think it's a large percentage.
I agree.
One of these exceptions for the easy form is probably going to apply to many borrowers. And so really what you're left with is those companies that had to reduce wages, they really weren't in an industry that got shut down directly. The economy might have slowed down, and that's why we laid people off. Demand for our product was reduced, but as long as you then bring back and restore your employees, that original safe harbor by the end of your covered period, or when you apply, then you obviously don't have a reduction factor either, but you can't use the easy form. That's the point. I think you have to prove all that out on the longer form. Any other comments on that? Did I miss anything on that, Doug?
No, I think that covered it well, for sure. So with that, let's move forward to next slide, please. And updated long form. they said they tried to simplify this. I didn't really see much change, to be honest, other than they pulled out the instructions into a separate document, made it look shorter.
Yes. Yeah, I
So,
agree. There weren't that many changes to the long form. So you've still got to do the Schedule A and show your FTE reduction factor. I guess what I wanted to show on this screen was there are still some opportunities if you have to use the long form, still some safe harbor opportunities to get you out of a reduction. And again, I go back to one of my original points when we started today. Even if you end up with a reduction factor, because you're going to have so much more payroll expense that you're going to be documenting, that you're starting with a higher bar. So once you apply those reduction factors, you're still going to be at or above your loan amount. So it's the lesser of your reduced forgiveness amount or your loan amount. So you could come out of this, even if you've got a reduction factor, with complete forgiveness, which that's fantastic.
Yeah, very good point, because I don't think up until we got some of this clarification that a lot of people really kind of thought through that whole process, but very true.
Yep. So I just wanted to kind of reiterate, where you won't, there's no need to calculate your FTEs. So if they had no reduction in FTEs from 1/1/20 through the covered period, you can check the box, and there's no need to calculate. It's assumed that your FTEs were 1.0. There's no reduction factor. Your reduction factor is 1.0. So you basically get to use 100% of your forgiveness amount. Safe Harbor 1, FTE reduction after 2/15/20 was caused by government health mandate or guidance. Check the box, no need to calculate. And then Safe Harbor 2, FTE reduction that occurred from 2/15/20 to 4/26 was restored by the earlier of the application date, or 12/31/20. So they've incorporated all of the safe harbors onto the long form. And I guess this is just in case somebody, I haven't really thought about it, but in case somebody fills out the long form, doesn't take advantage of the EZ form, you'll still end up taking advantage of one of these safe harbors, and you won't have a reduction. So I didn't really see any other updates to the long form or significant changes to the long form. I will say there is a place where you can say, here's the beginning of my covered period, and here's the end of my covered period. And obviously you can choose at that point what you want your covered period to be. It doesn't have to be 8 weeks. So that's how they handled that. We thought there might be a check the box. I want 8 weeks or I want 24 weeks, but because it can be a sliding scale of time from 8 to 24, I think they just left blanks for you to fill that information in. But everybody's covered period always starts with the day their loan was deposited in their bank account. So.
Yep. Next slide, please.
I think we only have a couple of slides left, and we hit this pretty hard, but I just want to document for everybody. And I copied this language straight from the EZ instructions, this first bullet point, and I'll just read the stuff in red there. And it says, and contributions on behalf of owner employees, and again, those are S and C shareholder employees, are capped at 2.5 months worth of the 2019 contribution amount. I don't know how you can get more clear than that. So it doesn't seem to me that it's included in the 2.5 months worth of your straight compensation, your cash compensation. It seems to me it's in addition to that amount. But if you look at the IFR for May 22, it basically says, in particular, C corporation owner employees are capped by the amount of their 2019 employee cash compensation and employer retirement and health insurance contributions made on their behalf. S corporation owner employees are capped by the amount of their 2019 employee cash compensation and employer retirement contributions made on their behalf. To me, it's ambiguous in terms of what the cap is. I don't think it's automatic, my interpretation of that, but I understand where you could come to that conclusion. And I do think, the two don't agree. I think we will get some clarification of this. They'll either retract, they'll update the form and retract that language in the EZ form. Oh, and I guess the last point is that same language is not in the long form. It's basically that description without the items in red there.
Exactly.
So,
and the other question we get around these this part, okay, well, if you're an ESOP company and it's the trustee that you've got there. Our interpretation related to ESOP companies is that's not the intent of the PPP, is to try to restrict those contributions from being included. So, again, it's sort of the reasonable man, use your best judgment type of thing. And that's what we've tried to do. Again, go back to the spirit of the law. And what they're trying to do is prevent any gaming of the system where owners directly can benefit to the detriment of employees. So if you go at it from that perspective, just try to think through reasonably, and typically that approach is fine.
Yep, I would agree.
So with that, next slide.
I think this is our last slide. So again, I just wanted to hit real hard and really document for everybody this way, because it is such a confusing topic. We get a lot of questions on this from folks. But to ensure that borrowers are not, and this is, again, straight from, what is it, IFR 14, it's in red down there, the loan forgiveness IFR. To ensure that borrowers are not doubly penalized, the salary/wage reduction applies only to the portion of the decline in employee salary and wages that is not attributable to the FTE reduction. So the example they use, an hourly wage employee had been working 40 hours per week during the borrower selected reference period, FTE employee of 1.0, and the borrower reduced the employee's hours to 20 hours per week during the covered period, which was an FTE employee of 0.5. There was no change for the employee's hourly wage during the covered period. Because the hourly wage did not change, the reduction in the employee's total wages is entirely attributable to the FTE employee reduction, and the borrower is not required to conduct the salary wage reduction calculation for that employee. So I think that's about as clear as it can be. So that's my last slide. That's my last slide.
Yeah.
I just want to put that out there for everybody. That was actually on a previous slide from a previous discussion, but it just remains to be a point of confusion. I think a lot of our clients are now diving into the form and the instructions and just now kind of encountering these confusing topics, and it is confusing. The instructions are not always that helpful. So sometimes you have to dive into the IFRs to kind of figure out what's going on. For
sure. And just before we get into the Q&A, a couple points I want to make too, having just started to review for some clients their forgiveness applications this week. As you think through it, and there was a lot of consternation early on, and still a little bit around audits. And gosh, am I going to be subject to audit? And again, as a reminder, maintain this kind of living document, this living file for 6 years. All this stuff has to be maintained for 6 years. But really be thorough when you go through your forgiveness application. Make sure everything matches properly. Your tax ID number is correct. The exact spelling of your entity and the owner and the person who signs it is correct. Because if you think about it, there's over 4.5 million of these loans out there, okay? The SBA is strained for staff. The government is going to be strained for staff in terms of what they're going to look for with audits. So make sure all of that stuff matches exactly, because I guarantee you they'll be using some type of advanced algorithms and things like that to do sampling. And you don't want to have those easy things that sort of kick you out. They're going to be looking for anomalies when they run the software and the programs to go through these things. So if stuff doesn't match exactly, and those type of details, you don't want that kind of thing to trip you up. So I say that really more so for the early applicants. Like I said, I've started to review some of those this week. The community banks are taking those applications manually in many cases, and then they are inputting those. That process, while it's nice that you can do that now, it's more rife with potential errors. That's why you're seeing many of the major banks not do anything yet in terms of taking those forgiveness applications until it can be fully automated. Some I know won't even start accepting any applications until August, for example. Many of them will probably do so later in July. The reason being is that, they don't want to touch this paper, and I totally get that. I don't think anybody wants to go through and touch all this paper. If you're a bank that has 50,000 of these loans, there's just no way you can do that. And there's no way the SBA can handle that. So that's why they're going to try to make it automated to reduce any potential for error. But you really got to pay attention to, working with your bank or banker to make sure that this is handled properly. So I just throw that out there as an overarching commentary. Take it for what it's worth. So with that, I guess we can get into Q&A.
Oh, I'm sorry. I had one last slide, and it's just really short. So there's a whole lot of guidance we still need. Obviously, it'll be really helpful if we get some certainty around the retirement contributions for owner employees. And we still don't know what transportation costs are. So, but again, because they've increased their measurement period from 8 weeks to 24 weeks, the expectation is that the vast majority of businesses out there are going to use up all of their loan proceeds with payroll expenses anyway. So this issue becomes less of an issue. So I don't know that we're ever going to get an answer to this question, but it's out there. So that's it. That was it. So let's get into some questions.
All righty. So the first question. Sure, yeah. The first question I have here, you guys mentioned that you're supposed to use up to that 60% for the payroll, but can you use the entire loan for payroll?
Absolutely, yes.
They would love you to do that. That is the absolute, that's the purpose of the program.
All right, the next question I have here is, as a very small business, I just received my PPP loan check this week. Can it be used to pay back lost wages, or can it only be used going forward from the time the check was issued?
Well, I would say, I'm not sure what you mean by lost wages. I always get nervous. Hopefully companies are paying their people. But if you have a payroll that wasn't made for whatever reason, was earned and wasn't paid, yes, you can absolutely use the PPP money to pay past expenses, and that applies for non-payroll expenses as well. Congress wanted this money to be used to alleviate some financial stress. So we didn't really, we kind of addressed the paid or incurred discussion earlier, but just to touch really briefly on it, because we are still getting questions. So it's a good question. Essentially, when you get your cover period starts on the date that you receive your loan, and if that happens to coincide with a pay date, that pay date, even though it was payroll, you're paying in arrears, even though that payroll was earned prior to your cover period, it is includable. You can use that money for forgiveness and use your loan proceeds for that payroll, and then you just continue to roll forward, depending on which covered period you select, and then let's just say you stick with the 8-week period. You get to the 8-week period, and maybe you've got a partial payroll at the end that's earned before the end of the covered period. As long as you pay that at the next payroll period or pay date, you're going to that's going to be includable in forgiveness. So potentially you're going to end up with more than 8 weeks. That's my point in telling you all this.
Right.
You end up with more than 8 weeks of payroll if you select that 8-week period. So anyway.
Just don't include any payroll that was earned or incurred after the end of your covered period expiration date. As you indicated, Paul, it can be, just to clarify for folks, it can be paid after, but you have to parse out anything that was earned or incurred only through the end of your covered period date. And this goes, we've had folks that have paid hazard pay increases or bonuses, things like that. again, those are includable as well. Continue.
Hey, Doug, I just got an instant message from one of our partners, and he wants me to clarify. Can they apply wages paid in the past to the forgiveness calculation, even though they just got the money? I hadn't really thought about that, but no, you can't do that.
No.
If you've already paid the wages, you can't use money. It's to be paid during that covered period. So
Correct.
Hopefully that clarifies things, and thank you to our partner. So next question.
All right, so we've gotten a lot of questions on this, so just hoping to clarify here. It says trying to determine if the 24-week extension means a business has the choice of either an 8-week measurement period or a 24-week measurement period, or can a business use a 10-week or 12-week period before the 24-week period is up?
Well, the answer is you have to choose either the 8-week or the 24-week period. However, if you use all of your funds, say in a period that happens to be 10.5 weeks or 12.5 weeks or 14 weeks, as soon as those funds are used, the entirety of your PPP funds are used, you can go ahead and apply for forgiveness. Now, there is some language in there. If you've reduced wages by more than 25%, then you have to extrapolate that out for the entirety of that 24-week period. I don't think that's going to apply in many cases, as Paul alluded to earlier, but you have to watch out for that. So you can't technically select your own covered measurement period. That strictly has to be 8 or 24. However, it's sort of, you back into it by the fact that you can apply as soon as your funds are depleted. Is that okay? Cover that okay, Paul?
I think so. You're right on.
And then
right.
Just one more on that as well. So do you have to declare for the 24-week period? Any formal notice required?
No formal notice. As I mentioned before, we thought there was going to be some box on the form, on the revised form, where you selected one or the other, but really they just, if you look at the form, it's on the page 1. It just wants to know what's the beginning date of your covered period and what's the ending date. And so depending on what ending date you select, it's either going to be 8 or 24 weeks. And if you haven't spent all your money, the only people that I would the only companies that I would recommend choose the 8 weeks are those that didn't have any trouble using at least 60% on payroll costs and have used up the entire amount of the money. If you haven't done that, then you're guaranteed you're not going to get full forgiveness. So why would you use the 8-week period? Hopefully that's clear to everybody. So in that situation, you're going to go with the 24-week period. But as Doug alluded to, the guidance we just got was you don't have to wait until the end of the 24-week period to apply for forgiveness. As soon as you spent your money, you can apply. So hopefully, I know this is confusing. I wish there was some way we could make it a lot less confusing, but it's just the way the information has come out. And the change from the 6/30 date to the 12/31 date, and change from 8 weeks to 24 weeks. It's just it's not easy to understand.
We're doing our best to clear it up.
Yeah.
So the next question we have here, we're gonna switch gears a little bit. It says, can you speak to the relationship between the economic injury disaster loan advance amounts received and the PPP forgiveness calculation?
So yeah, the EIDL advance, which was $10,000, which some folks have received, that is to be deducted from the PPP.
You'll indicate on the form the EIDL advance amount, and then for whatever reason they didn't show the deduction on the form, but you can fully expect, it's our expectation, that when the bank gives you forgiveness, they're going to deduct the EIDL advance amount that you've got. So you're going to have a little bit of a loan remaining, right, Doug? That's the practical impact of that. You'll have a little bit of a loan remaining, and if you haven't spent that EIDL advance amount yet, then you can obviously pay off your PPP loan, and if you've already spent it, then you're going to have to make payments for the next either 2 or 5 years, depending on what you negotiate with the bank.
Yeah, that's a good clarification, Paul. Thanks. But yes, we do know that the intent certainly was for that EIDL advance to be backed out of your PPP forgiveness.
Yep. Was it just the advance in the question? Was that what?
Yeah, not the EIDL loan. That's obviously different.
Okay.
All right, so the next question we have here is the PPP interest also forgiven if the loan is 100% forgiven?
Correct.
Yes, correct.
Next question. Let's save some time here. I'll stop
Can
blabbing.
you touch on alternative pay date?
So,
Go ahead,
we
Doug.
tend to get that question a lot. And again, with the flexibility up front, so I'll use some dates here. Say you got your PPP loan on April 15th, and then you had a pay date April 17th, and people are thinking, well, I'm gonna shift my covered period to coincide with that. If you go through the math, you really don't have to in most cases, because that pay that you made then on April 17th in that example is fully includable in your forgiveness, as Paul indicated earlier. So, and then at the end, you have 56 days if you're using the 8-week period for, let's say, just for ease. At the end, any pay that's incurred or earned up through the end of your 56-day period is also includable, even though it's not paid during that covered period. As long as it's paid in the very next regular pay date, you can include that. So you really, as Paul alluded to earlier, you can capture much more than 8 weeks or 56 days of pay in there. So make sure you walk through those dates carefully, because for most folks, you really won't have to change it to some type of alternative period. I think really where that comes more into play is perhaps if you have a very long payroll period that's not, say, weekly or bi-weekly. But to be honest, in the stuff I've looked at for a number of clients, haven't seen a lot of that. Have you, Paul? What have you experienced?
Yeah, so you have to have either bi-weekly or weekly in order to elect that alternative payroll covered period. But that notwithstanding, I would say that the advent of the 24-week period really it makes it. I think it makes it a lot more attractive to do the whole purpose of the alternative payroll covered period was to make it easier to document your payroll costs, because you're on a payroll cycle, and so you can just print off different payroll runs rather than having to cut, paste, and assemble pieces and parts of different payroll runs. And I realize technology has made it a lot easier to designate certain pay ranges and things like that. So, but I'm not a payroll person, so I don't know how difficult it is. But I do know there was pushback to SBA saying this is, depending on when my payroll fell, this is going to be really difficult for me to document my payroll costs based on my covered period. And so all they tried to do is help companies out by making it easier to document your payroll costs. The one thing, as Doug said, if you're choosing an 8-week period and you're going with the alternative, then you're going to be limited to strictly 8 weeks, right? You're locked in. It's going to be 8 weeks of payroll for sure. Whereas with the non-alternative, just sticking with your original covered period, you would potentially have more than 8 weeks of payroll in there, again, depending on how your pay dates fall. But with the 24-week period now, I don't think. I mean, you should have. It should be very easy if you did your calculation for your loan amount correctly. It should be very easy to spend 2.5 months of payroll in 24 weeks. I mean, that should not. I mean, everybody, when they did that, it really meant everybody was probably going to get 100% forgiveness, and that was really what they wanted to accomplish. They wanted to turn these loans into grants, right?
Yeah.
So
great point. Yeah,
I think we beat that. Well. I think we beat that to death, Doug.
No, that's very succinct and says it much better than I did. That's exactly right.
All right, so we're going to a few extra minutes to answer some questions here. So probably go about 5 minutes over. Any questions we didn't answer, we'll be sure to email you guys and get your answers to those. So
hey, Amani,
yeah.
I just want to throw out while I'm thinking about it. The first couple webcasts we've done, we were just absolutely inundated with emails. And so you guys did a great job of capturing all those in a spreadsheet. And Doug and I did our absolute best to try and respond to all of them, but I know we weren't able to because on a daily basis, we're getting crushed with emails from everybody else, clients, referral sources, whatever, as well as phone calls, and we got our own jobs to continue to do on a daily basis. So I would tell anybody in the audience, if you have a question that you really need an answer to and you can't wait, please go ahead and email it. And I'll tell you, you can email it to Doug, you can email it to me, and there's another guy at Ray, a guy named Matt Long, who's on our PPP task force. If you include all of us in the email address, one of us will get back to you pretty quickly, and it's easier for us to kind of share the workload if you ask the question to all of us. So I'm not saying you have to send an email to us, but if you really need an answer and need some guidance, that's the best way to get it. So go ahead, Imani. I just want to throw that out there because I know there was some frustration with some folks that we weren't able to get back to after the last couple of webcasts.
Sure. Thanks, Paul. And Rebecca, would you mind dropping those emails in the chat so people can kind of copy and paste those? So the question we have here is, if I am self-employed and use PPP funds to pay contractors, am I still eligible to use the easy form?
If you say that again, can you ask the question again?
They use,
sure.
Sounds like they use PPP funds to pay independent contractors.
Yeah, so if I am self-employed and use PPP funds to pay contractors.
Well, that's technically not allowed. So I think it's all in how you document the use of the money. So I think I'm interpreting this to mean there are no employees. So that would mean you could use the EZ form, but you will need to document that you paid yourself. You made those distributions to yourself, and you didn't pay independent contractors when it comes to documenting that you used the money for the right thing. Now, maybe that's a technicality, and I really don't think the government's going to be going after people without any employees, but technically, as a sole practitioner with no employees, you're limited to your 2019 net self-employment net earnings, net profits from self-employment, or $100,000, whichever is less. So what we've been telling clients is just write a check to yourself. If you normally take a draw, and hopefully you've got, I realize not everybody has a business checking account and a personal checking account, but if you do, it's really easy to write a check from the business to yourself to document that expense. You shouldn't be documenting payments to independent contractors. Independent contractors are able to go out and apply for a PPP loan on their own.
Yeah, an additional point to that, if your PPP loan was based on some of that, and it shouldn't have been, as Paul indicated, I would work with your bank to pay those funds back right away. We had some early on where there was certainly a lot of confusion and unknowns, and we know of several PPP loans that they were funded based on some 1099 independent contractors, and again shouldn't have been. And they work with their institutions to pay that portion of the loan back right away without any issues.
Yep, great point. Great point. I didn't think that all the way through, Doug.
Great, we're going to do two more here. This one says, we as an employer did not reduce hours, but many employees chose not to come to work. We wanted them to come to work. We didn't pay them to stay home because we needed them here. And if we paid them to stay home, we wouldn't have had anyone show up. So does that reduce my FTE since they chose not to show up and therefore stop me from using easy form?
So if somebody voluntarily didn't work, then that is not a deduction from your FTEs.
You have to document that. They're right, Paul. There's required documentation to show that they chose not to work. But
correct.
To your point, it doesn't penalize you.
Right. So if if you've laid people off and they wouldn't come back because they wanted to be on unemployment or whatever, we've had lots of those questions. Not so many now, but early on, you know, you're not held, you're not responsible for that. You just have to document that you offered them their position back. If you eliminate somebody's job for cause, or if you fire somebody, basically, they're not held against you. If somebody leaves voluntarily, they're not held against you. So it's really just people that were laid off as a result of the crisis.
All right, and the last question we have here is, if loan forgiveness is granted in 2021 after 2020 tax returns are completed and submitted, what happens to the payroll costs that were deducted and are no longer deductible?
Well, it's too bad that we don't have Matt Long on here, and I think he's made this observation too. And maybe I'm assuming the question here, but yeah, I think that we do need some clarity around whether these forgiveness expenses are going to be deductible or not. We expect to know that one way or the other. If we get it, if we get that relief, that tax relief, it's going to come attached to legislation, probably this PPP 2.0 that you referenced, Doug, or if you want to call it a stimulus, another stimulus bill. We're not expecting that to happen until the end of July, August timeframe. So there's going to be a little bit of time here, and I guess you're going to have to kind of figure out, do you want to pay in those estimated tax payments? You know, what decision do you want to make? I will tell you, I think there'll be some leniency that the IRS will impose around this. They understand that there's an unknown here. I do think it's more likely than not that we're going to get the relief that we want. But there is bipartisan opposition as well as bipartisan support. But AICPA on the town hall addressed that topic specifically yesterday, and we do think that we're going to get that there's more bipartisan support for that change. IRS is dead set against it. I think Mnuchin is on record as being dead set against it. So if it's going to happen, it has to happen through legislation. It's not going to happen through an IRS regulation. So IRS has already put out their guidance.
Yeah.
Anything else?
To that question, if it stays as it is now and those expenses aren't deductible, and the forgiveness doesn't happen until, say, after you've filed your 2020 return, you'd have to go back and amend that return, would be my guess.
Yeah, I don't know how that's going to work. Hopefully, we'll get some additional guidance. If it's not forgiven prior to the end of the year, and you don't get that, it would still be a loan, right? So
right, and it's the income is not that the forgiven loan amount is not includable as taxable income. It's really tax neutral. But I don't know. Hopefully, we get, as you said, we get some guidance well before all of that occurs.
Okay. So yeah, sorry, we don't have a real good answer for you on that. There's still a lot of unknowns around that that issue. We're hoping that it'll be resolved here sooner rather than later, in the next few months.
All right. Well, thanks, guys, and thank you all for joining us for today's live broadcast. What is Life After Coronavirus? PPP, the final chapter. We hope today's team was able to provide you with some valuable insight that will help you secure the funding you need amid this economic uncertainty. If you sign off today and realize that you have additional questions, you're always welcome to reach out to Paul, Doug, or Matt directly, or as Paul said, please include them in the same email so they're able to reach out to you guys. You can also contact any of our RAID team members by checking the people section of the firm's website at www.raidcpa.com. Don't forget to watch your inbox for an evaluation survey, access to the recording of today's webcast, and more. Thank you, guys, and we hope you have a wonderful rest of your day.
Thanks, everyone.
Thank you.